All right, let's dive into Carlisle Companies, ticker symbol CSL. We're going to go way beyond just looking at the day-to-day stock price. We're going to get under the hood and see what's really making this company tick, financially speaking. You know, when you open up a company's financial report, it can feel like you're staring at a giant wall of numbers and jargon. It's a lot. So the real question is, how do we break through all that noise and figure out the true story? Well, here's how we're going to do it. We're going to put Carlisle through a full financial health checkup. We'll look at its vital signs, test its strength, and check on its long-term growth. It's a really simple way to get a clear picture of what's going on. Okay, part one. We're checking the vitals. Just like a doctor checks your heart rate, the first thing we need to know is how profitable the company's core business actually is. Is it healthy right at its center? And the very first test we run is for return on equity, or ROE. The easiest way to think about this is, for every single dollar that shareholders have put into the company, how good is the company at turning that dollar into pure profit? It's a huge deal for measuring efficiency. And wow, Carlisle's ROE comes in at an incredible 41.26%. Now, just to give you some context, anything over, say, 15% is usually seen as pretty darn good. So this is a massive green flag. It tells us the company is just exceptionally good at making money with its investors' cash. But was that just a fluke? A one-time lucky break? Well, this is what I find so compelling. Their current net profit margin is sitting at 19.54%, which is right there with its 3-year average. In fact, it's even a little bit higher. This shows us that high profitability isn't an accident. It's just how they do business. It's stable. So the vital signs look amazing. The company's core is clearly profitable and consistent. So now it's time for a strength test. You know, how resilient is this company really? If things get rocky in the economy, can it handle the stress? Okay, we've got two sides of the financial stability coin here. First, that current ratio is a super healthy 3.09. That means for every $1 of bills due in the near future, Carlisle has over $3 in assets ready to pay them. That's a huge safety net. On the other side of things, its debt-to-equity ratio is 1.60. So this tells us the company isn't afraid to use debt to fuel its growth. It's very liquid, for sure, but that leverage is definitely something we need to keep in mind. So a healthy company isn't just stable today. It should be getting stronger over time, right? And it should be rewarding the people who invested in it. That brings us to part three, looking at growth and shareholder rewards. And this number, this just says it all. 49 years in a row of increasing its dividend. Think about that. We're talking almost half a century of giving more money back to shareholders every single year through all the market ups and downs. That is a massive signal of confidence from the company's leadership. And we're not talking about tiny little increases either. The growth is actually picking up steam. Over the last 5 years, the dividend has been growing at a compound rate of nearly 16% per year. That shows a real aggressive commitment to growing those payouts. Okay, now this is where the plot thickens. If you just look at the short term, you'd see that net income in the last year is down over 43%. And that looks pretty bad, right? But if you zoom out and look at the last 5 years, you see this incredible growth story, with income growing at over 18% a year. So the whole trick is to understand this recent dip within the much larger context of a powerful, long-term upward trend. So does all this internal financial health actually lead to returns for investors? Oh yeah, absolutely. Take a look. This is the total return. So that's the stock price going up plus the dividends. It doesn't matter if you invested 3, 5, or 10 years ago, Carlisle has delivered really strong, consistent double-digit returns. So we've checked the vitals, we've tested its strength, and we've measured its growth. It's time for the final part of our checkup, the final diagnosis. After all this, what is this company stock actually worth? So here it is. This is the number that everyone sees. The last closing price for a share of Carlisle was $360.07. That's the market's price tag, our starting point. But here's the million-dollar question. Is that the right price tag? After everything we've just seen, its profitability, its stability, its history of growth, what do the numbers suggest this company is really worth? Based on our analysis, the estimated fair value is $753.37. Just let that sink in for a second. That is a massively different number from the current stock price. It suggests there could be a huge gap between the price and the actual value. And that gap has a name. It's called the margin of safety. In this case, it's over 52%. What that means is the stock appears to be trading at less than half of what it might be intrinsically worth. It's like a potential built-in cushion for an investor. So it all comes down to this one big question. You have a company with what looks like stellar long-term financial health, but it's hitting a pretty serious short-term rough patch with its income. When you see a potential margin of safety this big, does that recent dip scare you off, or does it make this look like an undeniable opportunity? That's the question to chew on.